and welcome to the Business Standard Morning Show. I'm Nazia Iqbal, and here's a look at the stories for the day.
This is GE Vernova, helping generate and move the energy that will change the world. Welcome to a new era of energy.
India's digital rupee is making its retail debut today. Soon, people like you and me will be able to use this digital currency for daily transactions. Now, if you already use digital wallets and UPI, you may ask, how will E-rupee be any different? Bhashwar Kumar answers this question for you.
A sizable number of Indians have switched to digital payments with gusto, whether they are paying at a high street store in Delhi's Khan Market or a tiny kirana in a tier 3 city. Take UPI for example, which saw transaction volumes increase by about 9 times between FY19 and FY22 to 46 billion transactions. The likes of Paytm, PhonePe and Google Pay have become household names, and soon the digital payments ecosystem will have a new addition. The Reserve Bank of India is coming out with its own digital currency. RBI is launching the first pilot for the retail version of India's central bank digital currency, or the E-rupee, today. The pilot project is initially being launched in 4 cities: New Delhi, Mumbai, Bengaluru and Bhubaneswar. Customers from these selected pilot cities will be invited by their banks to participate. Subsequently, the pilot will be extended to Ahmedabad, Gangtok, Guwahati, Hyderabad, Indore, Kochi, Lucknow, Patna and Shimla. First, let's settle what a CBDC is. In simple terms, it is a legal tender issued by a central bank in a digital form. It is exchangeable at par with existing currency. There can broadly be 2 types of CBDCs based on 2 factors. First, its usage and function. Second, the different levels of accessibility. The 2 types are general purpose or retail CBDCs and wholesale ones. A retail CBDC is an electronic version of cash meant to be used by the common man in everyday transactions, from buying groceries to paying the electricity bill. While a retail CBDC would be available for use by all, access to a wholesale CBDC would be restricted to select financial institutions. The pilot project being launched today is in the form of a digital token that represents legal tender. It will be issued in the same denominations as paper currency and coins. The token will be distributed through banks. For their part, users will be able to make payments using the E-rupee through a digital wallet offered by the participating banks and stored on their mobile phones. The transactions can be both person to person as well as person to merchant. Let's say you're at a shop. You can pay for the items you've bought using the digital rupee QR code shown by the merchant. While the retail CBDC will not earn any interest, it can be converted into other forms of money such as bank deposits. So, how is the CBDC different from other digital payments like UPI?
So CBDC is a faster, cheaper, more secure, and I would say an efficient form of domestic and international digital payments.
If I have a wallet today, effectively, I have cash in my bank account and I'm able to link my bank account to a digital wallet and make payments using that wallet. In a CBDC wallet, the token is itself the currency. There is no underlying representation of the currency. There's no cash in a bank account. If I'm using a wallet today, a UPI based wallet which is linked to my bank account, if I transfer money from my wallet to your wallet, that transaction gets recorded immediately, but at the back end there needs to be an actual settlement between the 2 banks. In a CBDC based wallet ecosystem, it's completely different. There is no back-end settlement. The settlement is simultaneous with the payment. The moment I transfer that token, so if I'm transferring 100 rupee digital token from my account to your account, the moment I transfer that token, The payment and the settlement occur simultaneously and the transaction is completed. The big advantage of a CBDC is that it allows for zero settlement risk in some sense and very low transaction costs.
A retail CBDC can also provide you access to safe money for payments and settlements, as it is a direct liability of the central bank.
So private cryptocurrencies today are not sovereign backed. They're not fiat currency. They're issued off a blockchain and many of them are open networks. Whereas a CBDC is could very well, and I know the RBI is sort of talking about what will be the back end technology, and the blockchain is one possibility. But a CBDC is also a digital currency that's issued, for example, off a blockchain, but it has sovereign backing. It is in effect fiat currency. So when you're talking about safe currency, the real parallel is to a private cryptocurrency.
According to IDFC First Bank MD and CEO V. Vaidyanathan, the CBDC is also more anonymous than traditional digital transactions. But what does that really mean for you and me?
So the RBI has said that they want the CBDC to operate as close to cash as possible. And we all know cash is anonymous. Whereas if I'm using my wallet today that's linked to my bank account, there's a complete KYC done on my bank account. Every transaction is monitored and recorded. The RBI has indicated that perhaps for small value transactions, and this is something other jurisdictions have done as well, perhaps for small value transactions, it may be anonymous, which means it's just the transfer of the token that is recorded. It's not an account-based transfer. So the fact that I made the transfer to you will not be recorded on the database. It's just the transfer of the token from one wallet to another.
The CBDC is also expected to make cross-border transactions cheaper.
I think the cost of today international transfers is much more expensive for any common individual. Plus the settlement takes T plus 2 days or T plus 3 days, depending upon where the money is coming from. And multiple levels of forms, multiple level of KYC to be done. With CBDC, that actually becomes much easier. So personally, I believe the cost of doing the transaction should come down with a instant ledger between the financial institutions and the central banks between different countries. And the currency could be exchanged in a more real time in a spot basis versus the exorbitant charges that the consumers have to pay on buying and selling the currency, or the banks have to pay on behalf of the consumer.
The pilot's first phase shall commence with 4 lenders: State Bank of India, ICICI Bank, Yes Bank, and IDFC First Bank. 4 others, Bank of Baroda, Union Bank of India, HDFC Bank, and Kotak Mahindra Bank, shall join the pilot later. From a larger perspective, it is hoped that the E-rupee will reduce the cost of physical cash management, increase welfare for the poorer sections, and make financial services more accessible to the unbanked and underbanked. These outcomes will take time to materialize. Till then, one way to measure its success may be to see if it actually dissuades the common man from heading to risky media like cryptocurrencies.
Meanwhile, in another milestone for India, the third version of semi-high-speed Vande Bharat train chugged off from the stable of Integral Coach Factory recently. The government is now keen on starting its export too, and it also plans to roll out over 300 more of these trains in near future. But one of the main brains behind this sophisticated train, Sudhanshu Mani, is a reclusive man. Debarga Sanyal caught up with him to learn more about his journey.
He does not have a Wikipedia page to his name. His media appearance is minuscule as compared to the thorough coverage his inventions have had. The Wikipedia page for Vande Bharat identifies him merely as the former general manager of the Integral Coach Factory, or ICF, which he is. But Sudhanshu Mani is in fact the main brain behind the semi-high-speed trains that the central government has increasingly cited as the crowning achievements of its railway policies. Mani belongs to the 1979 batch of Indian Railways Services of Mechanical Engineers and retired from active service in railways on 31st December 2018, only a couple of months after the Vande Bharat train was rolled out. He has over 36 years of experience in Indian Railways and has worked in areas like workshop management, railway operations, project management, planning and R&D. Mani describes himself as a railway man for life.
So I'm what you would call a railwayman for life. So I joined railways in 1976 as a special class railway apprentice. 76 to 2016, till I got posted as a general manager of Integral Coach Factory, I was a railwayman and had worked in all aspects of railway working, operations, maintenance, design, manufacturing. And I requested for a posting in Integral Coach Factory because I thought before I retire, if it was possible to use the expertise and the skill of the ICS staff to give the country a semi-high speed, modern, aesthetically superior train.
Vande Bharat wasn't Mani's first major project. He had been associated with the design and upgradation of several diesel locomotives between 1990s and early 2010s. During this time, diesel locomotives were primarily used for freight transportation in India.
I was associated mainly with design of diesel locomotives from since early 90s till I would say about early 2010s. Several designs of diesel locomotives were turned out, and I was involved in each and every one of them. This was in upgradation of power from 2400 horsepower to up to 4500 horsepower. And the biggest project was a 5500 horsepower locomotives, a collaborative project with General Motors, EMD, RDSO, and DLW.
The former GM of ICF was also at the forefront of convincing the central government that a semi-high-speed train was indeed possible.
The challenge was, first of all, to get a sanction from the ministry to do such a train because it would hurt the import lobby. Ultimately, the chairman railway board gave us a sanction for only 2 trains. After I told them that you could go ahead and import whatever you want, but we will build a train at 1/3 to 40% of the cost of import. The other challenge was such a project usually takes 36 to 42 months from concept to design, engineering, manufacture, validation. In the final analysis, it was got done in 18 months and it kind of relived its name.
Lalit Chandra Trivedi, the former general manager of Indian Railways of East Central Railway Zone, also points out that the Vande Bharat's full capabilities are yet to be fully realized.
Even today, the full potential of the Vande Bharat Express, we have not been able to exploit because of our infrastructure issues. Like Vande Bharat is capable of running at 160 kmph, but most of our track is capable of 110 kmph. I was in ICF when we were making this. So that time a normal coach train will cost about 12 crores per coach. And here we could make in ICF 1 coach for 6 crores. So to produce a world-class coach at half the cost is another USP of this train. And this train has brought Indian Railways, our country, at par with in technology level, at par with European countries, Japanese, Japan, and other high-speed countries. We could have done more, but for the basic infrastructure.
Despite the hiccups, Vande Bharat is indeed a major milestone in the history of the Indian Railways. As Mani points out, the train service is a catalyst for further changes in the Indian railway infrastructure. And it is now for the future generations of engineers and innovators to unleash the semi-high speed train's full potential onto the Indian tracks.
Let's move on to markets now. The rally in public sector banks after their impressive September quarter performance may soon fizzle out. While the outlook for the sector remains optimistic, analysts say the street has priced in all the positives. With over 70% rally in the Nifty PSU Bank Index in just 5 months, should investors turn to their private peers for better return? Let's find out in our next report.
The runaway rally in public sector banks may soon run out of steam. Analysts indicate markets have priced in most of the positives and the road ahead will depend on each bank's respective financial performance.
Surprise is not left because now that is to a large extent price rate. The surprise was for PSU banks. They also came back to credit growth and they caught up with the industry credit growth and improved the credit growth. But why I'm optimistic is that instead of surprise, I would say two structural changes. One, last 5-6 years, the whole industry was worried about net NPA of the banking sector. Now, last two quarters, the net NPA is going down. This is a one major structural change. So, when NPAs are down and on the declining path and the credit growth picks up, what happens? The incremental impact will be there on the profits. Because as you grow faster, more profit before provision, but your need for making provision will be relatively lesser. So, the bottom line expansion would happen.
PSU lenders posted an improvement in operating performance in Q2 led by 3 to 8% loan growth quarter on quarter across the board. Deposits, however, saw modest growth in the range of 0.5 to 6.8%. While margins expanded up to 31 basis points, gross NPA ratios improved up to 177 basis points quarter on quarter. In comparison, private banks posted a sequential uptick of 2 to 6% in credit growth with average deposit growth of 5% quarter on quarter. Analysts feared the financial performance of PSU banks may come under pressure in quarters ahead as they begin raising deposit rates.
The impressive credit growth in the economy, now running at around 17%, and the rising interest rates are the fundamental reasons behind the superior performance of banks. Since the interest rate on a bulk of the loans are benchmarked to policy rates, the 190 basis point rise in repo rate and the less than proportionate increase in deposit rates have boosted the bottom lines of banks. Going forward, the PSU banks will continue to do well for a few more quarters, but their margins are likely to come under pressure from the rising deposit rates.
On the bourses, the Nifty PSU Bank Index has valued 70% from its June low. The Nifty 50 index, on the other hand, has surged 21%, while the Nifty Private Bank Index is up 33% during the period. The steep rally has narrowed the valuation gap between public and private sector banks. According to Bloomberg data, the price-to-book value of 8 of the 12 Nifty PSU Bank Index constituents is between 0.9 times and 2 times. These include Indian Overseas Bank, SBI, Bank of Maharashtra and Bank of Baroda. For the remaining 4, it ranges from 0.64 times to 0.85 times. In comparison, the PB for private banks runs between 0.5 times and 5 times. Analysts say the current valuations leave little room for upside.
This is the time to start taking profits from PSU banks because historically they were always around one-time book value, adjusted book value, because their credit growth is much inferior to the private sector bank credit growth. Now these banks are trading at half of adjusted book value. Now they recover to almost one time. So which is, a fair value if you go by historical standard. I would say that not more than 5-10% upside for public sector bank, but on the contrary, they can correct, 10-15% also, because as I said, some of the banks even trading at, 1.3 times, which is, in line with the historical valuation for them. But private sector banks, I feel, they would be outperformer in relation to the Sensex and Nifty. So I believe this is the time to shift from PSU to private sector bank.
On Thursday, investors will react to the Q2 GDP and IIP data released after market hours on Wednesday. Besides, they will track auto sales and manufacturing PMI data. Globally, the fine print of US Fed Chair Jerome Powell's speech will guide the mood.
Markets regulator SEBI recently told RBI that some non-bank lenders were evergreening loans by using alternative investment funds. But what exactly is this fund? Let us decode it for you. Alternative Investment Fund, or AIF, is any fund established in India which is a privately pooled investment vehicle that collects funds from sophisticated investors, both Indian or foreign, for investing. This fund can deploy its money in accordance with a defined investment policy for the benefit of its investors. AIF does not include funds covered under Indian market regulator SEBI's mutual fund regulations. Those wishing to form an AIF can seek registration in 3 categories. Category 1 AIFs can invest in startups, early stage ventures, social ventures, SMEs, and sectors which the government or regulators consider as socially or economically desirable. They include venture capital funds like angel fund, SME funds, social venture funds, infrastructure funds, and such other AIFs as may be specified. Category 2 AIFs are those which are not classified under Category 1 or Category 3. They do not undertake leverage or borrowing other than to meet day-to-day operational requirements and as permitted in the regulations. Various types of funds such as real estate funds, debt funds, private equity funds, funds for distressed assets, etc. are registered as Category 2 AIFs. Category 3 AIFs are funds which employ complex or diverse trading strategies and may employ leverage including through investment in listed or unlisted derivatives, hedge funds, pipe funds, etc. are registered as Category 3 AIFs. Category 1 and 2 AIFs are required to be close-ended and have a minimum tenure of 3 years. Category 3 AIFs may be open-ended or close-ended. An AIF under the SEBI regulations can be incorporated in the form of a trust or a company or a limited liability partnership or a body corporate. Most of the AIFs registered with SEBI are in trust form. No scheme of an AIF, with the exception of angel funds, shall be more than 1,000 investors. In case of an angel fund, no scheme shall have more than 49 angel investors. An AIF cannot make an invitation to the public at large to subscribe its units and can raise funds from the sophisticated investors only through private placement. Each scheme of an AIF shall have a corpus of at least 20 crore rupees. In case of an angel fund, it shall have a corpus of at least 10 crore rupees. AIFs other than angel funds also cannot accept an investment of value less than 1 crore rupees from an investor. In case of investors who are employees or directors of the AIF or employees or directors of its manager, the minimum value of investment shall be 25 lakh rupees.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
So that's how AIF or alternative investment funds work. However, these funds cannot go for public offering. Well, that's all we have for you today. We will be back with more news and analysis in our next episode. Stay tuned. Thank you for watching. If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.